Hello, everyone. Welcome to this joint EPC European Investment Bank panel on the post-COVID corporate debt overhang, how to restore and repair Europe's balance sheets. Just a quick note just before we start. Unfortunately, Victoria from the European Investment Bank has been detained, so we're joined by her colleague Andra Migui for now. Victoria may be able to join us a bit later, but we'll see how that goes. COVID's been a unique economic shock. Extensive public support have protected firms and individuals alike, but that hasn't stopped the worstly impacted firms from having to take on extra debt, from seeing their revenues plummet, from really battering their balance sheets. We've seen several warnings about a wave of insolvencies hitting Europe once public support begins to be withdrawn. This could threaten a still uncertain economic recovery, drag down private investment across the European Union, coming at a time when policymakers are relying on a new wave of private investment to really drive through the digital and green transition. Resolving this debt overhang as swiftly and as efficiently as possible will be one of the key challenges for policymakers as we exit the immediate health crisis and begin rolling back emergency support measures. We've brought together a really distinguished panel to discuss these challenges for you today. We have Alexandr, who's head of the unit at ECFIN at the European Commission, Becker, Professor of Finance at the Stockholm School of Economics, James Watson, Director of Economics at Business Europe, and Andra Migui stepping in for Victorica from the Pan-European Guarantee Fund Implementation Unit at the European Investment Bank. Just before I hand over to the panelists for their introductory remarks, could I just let the audience know that if you have any questions that you want for the Q&A now, I would encourage you to send them through now so that we'll be ready to present them to the panelists once we move to the Q&A and the panel discussion. So please don't shy away from using the Q&A function early should you have any questions. I'll now hand over to Alexandr Hobza, from the European Commission for his opening remarks.
Okay, good morning, everyone. Now, may I ask you I prepared a couple of slides for you to set the scene. Okay, we can go straight away to the first slide, exactly. So in my couple of minutes, I would like to provide you with the diagnosis or where we stand, what the impact of the COVID crisis has been on firms, and also give already some pointers for policies, which will then be the main topic of our discussion. So, as you all know, firms have been one of the main victims of COVID-19, and on the graph on the left-hand side, you can see the projections or the actual impact of COVID on revenues of firms in different sectors, and also projections until the end of this year, obviously based on a number of assumptions. I mean, what is quite clear from this picture is that the initial impact of COVID was huge and affected in particular some specific sectors. In this sense, it was very different from so-called normal recessions, in the sense that it was in particular contact-intensive sectors like services, accommodation, food, and so on and so forth, which were affected most. But in the first wave, it was also durable goods like automobile production and so on and so forth. Now, in the second wave, the impact on some of these sectors was slightly less, but still sectors which rely on very close contacts with their customers have been affected very badly, and our predictions are that such impact will persist and only diminish moderately over the year. So what does this mean? I mean, effectively, firms which were faced with such a huge impact on their revenues were not able to adjust all their costs in a proportional way, and many of them got under liquidity strain. This was in particular firms which already started in weak positions, or SMEs, which typically have smaller buffers than bigger firms. So on the right-hand side, I would like to show you some simulations on what impact on liquidity positions of firms in different sectors is. There you can see that around 1/3 of firms in the EU might suffer from a liquidity gap. towards the end of this year, even after some of the helping measures from governments in the form of short-term working schemes or moratoria on debt or for interest were given. And then these schemes, they have helped a lot. For example, the short-term working schemes, which were also kept at the EU level with the scheme, the so-called SURE scheme, have helped between 1.5 to 2.5 million of firms, and encompass some I think 20% of workforce in March 2020. You know, at the peak when the initial wave hit companies the most. So still, there is this huge liquidity needs on the side of companies, again concentrated in some sectors like accommodation and food. Transport equipment was initially the biggest impacted sector, but then, you know, in the second wave, which hit the sector less, situation improved somewhat. Now, good news, and can I ask another slide, please? The good news is that compared to the financial crisis, which we've experienced basically in 2008 onwards, the financial sector has not been affected that badly so far, and the credit channel has continued working. So effectively, many firms were able to tap the financial markets and plug the liquidity gaps to a large extent. I mean, this was obviously also because of the support measures from governments. There was a very important take-up of government guarantees. And on the left-hand side graph, you can see that there is a correlation between the liquidity shortfalls by countries and sectors, and also the extent of credit that was granted to companies. So far, so good on this side. On the other hand, one has to mention that all this credit went mostly to boost cash buffers of firms, so to be ready for this uncertainty which was brought about by the COVID crisis, and not necessarily for investments, which is the usual way why firms borrow money. So there is a huge investment squeeze, and that could also be a big problem on the way ahead. This means that although we have managed to avoid this liquidity issue thanks to all the policy support, firms are getting into solvency issues. So their balance sheets are worsening, equity is being exhausted, and once this support is withdrawn, one can expect many firms to get into troubles and be forced to exit, or to be at least at risk of exiting. So on the right-hand side, I'm showing some simulations that we did, which try to see what proportion of firms might be at the risk of exiting. On the one hand, firms which would have probably been in this risk also without COVID, and on top of this, excess exit, which might be due to the shock coming from the COVID-19 pandemics. There you can see that there is a huge diversity across countries. You know, already the pre-COVID kind of normal times potential exit is around 10% of firms, and COVID on average in the EU doubles this number. Obviously, some countries, those which are more exposed to the sectors, or which have a higher share of sectors which were most affected by COVID, there all these figures are significantly higher. So clearly, what does this mean for policy? I mean, when we go ahead, once the blanket kind of liquidity support which has been provided to firms so far, and which, as I said, was largely effective, and which should stay in place until the recovery is well embedded, then there will be time to go towards more solvency-oriented measures, to help firms which are viable but whose balance sheets have been badly affected by COVID to kind of regain their viability and then adjust to the new post-COVID normal. To do so, and then also in a view of fiscal space, which is progressively getting more limited. Obviously, one will have to target such support more towards firms which have which are viable, and then which actually, some of which already before the crisis might have been in troubles and then might not be able to adjust to the post-COVID times. So this raises a number of questions how to do this, and then probably we'll come back to this during the discussion. Now, next slide, please. So we see that there is a huge potential for increasing bankruptcies, obviously subject to the policy reactions and also the strength of the recovery. So far, we have not seen this in the data. Partially thanks to the measures that have been put in place, including moratoria on bankruptcies or some procedures. The bankruptcy rate in the EU has actually declined in the second quarter of 2020, and also according to the latest data for the fourth quarter, which is out, I think 2 days ago, we have not seen too significant pickup. But linking this to my previous slide, there is a potential for increase in bankruptcies, and we have to be ready for that. I mean, this implies this puts a huge premium on effectively functioning insolvency and pre-insolvency frameworks. I mean, clearly firms which can be restructured should be restructured, and this should be done in as quick and kind of preemptive way. Obviously, if we will not manage to save all firms, and then those which eventually get into insolvency situations, those should be resolved as quickly and smoothly as possible in order to release the resources to be used for other more productive needs. But on the left-hand side in the graph, we see for insolvency scores based on World Bank rankings in EU countries and also compared to the US. What you can take away from this is that there is a huge diversity in terms of the efficiency of insolvency proceedings in the EU, and in general, their efficiencies is lower than that in the US. So there is a huge scope for improvement, and then also reasons to push in that direction.
Sorry to interrupt, Alexandra. Could I just ask you to wrap up? I mean, a lot of very interesting points there that we'll be able to pick up in
yeah, exactly. So actually, I'm coming to the end. Last two sentences. An very important aspect of this is not only for the insolvency laws and proceedings, but also the capacity of countries to be able to process such bankruptcy proceedings. For this is not an easy case, but also resources from the RRF program, where member states are currently discussing and then finalizing their recovery plans. Resources from them can be used also for this purpose. And my very last point, I mean, in all this very difficult environment for firms, and what will eventually be a key factor is how strong the recovery will be. So this really speaks in favor of important stimulus for recovery, which as a whole also the RRF facility can provide. So let me stop here.
That's great. Thank you, Alexander. Some really excellent points there that I'm sure we'll come back to. I'll head over to Bo now for his opening remarks.
Thank you very much. Thank you for having me here today. This seems like an excellent topic to discuss. There's lots of movement, and obviously some things are not quite known yet. I think many people feared to begin with that there would be much more insolvency by now. And so this is testament both to the resilience of many economies and to the power of the public policy response so far, that we haven't seen much. But of course, a lot of the support has been in the form of debt, and a lot of private solutions to missing cash flows also involve taking on debt in private capital markets. So right now, debt levels are high. So I think this is a good time to ask what's going to come next. Maybe we just postponed all the trouble. I don't know the answer, let me say that. But let me point to the diverging message from different places. So on my slide here, is an analysis based on French tax records, which indicates that there are a lot of firms that were not insolvent before COVID-19, but which are now. And they're hanging on through some combination of public support and private, new funding or patience or something like that. So this suggests that there are many firms that are in trouble. If you ask financial markets, I think the story is quite different. So they say basically everything is fine right now. There are many ways to think about how you would ask financial markets how things are going, but I picked one that I think is reasonable, as reasonable as the next one. And this is the spread on high yield bonds. I have a red line here for the the Euro area, and a blue one for the US. And this is how much more a corporate bond that's rated BB or worse gives per year than a safe bond. And so you can see a spike here. This is when the COVID, in March last year, when COVID really kind of hit financial markets the first time. And spreads widened a lot. They did not widen as much as back here in 2012 when we had the sovereign debt crisis, and certainly not as much as in the global financial crisis. So they were high, but not super high, and now they're way back, and they're approaching all-time lows. So financial markets don't seem very worried. If financial markets were worried, we'd think that these spreads would still be very high. So let's take a step back then from the forecasting and say what happens when we have a lot of insolvent firms. I think it's important to recognize that insolvency is part of a healthy economy. And if you think about firms that are solvent in the sense that they can pay their debts and insolvent, it's not the same as whether their business is viable or not viable. And this distinction is key. So in normal times, companies are profitable, working fine, paying all their debts, they're viable, and the firms are solvent. You can also think about a firm that's structurally unprofitable, unable to pay its debt, and we would like to liquidate it to free those resources up employment capital to move to other sectors, other firms. It's more complicated in the other corners. So a firm that is solvent, so it's in good financial health, maybe has no debt, but is not viable, meaning it's structurally unprofitable, that is the owner's problem. And so there's not really any need for public intervention. If the owners want to keep running it at a loss, so be it. Maybe they love that restaurant. The most interesting square in this scheme is insolvent firms that have a viable business. And I think this is the key. And this is sort of what we're concerned about is accidentally liquidating or closing down businesses that are viable, but that are insolvent, for example, because they've taken on a lot of debt recently. So what are some of the challenges? A quick run through. So the first one is you need to identify which firms are viable when they can't pay their debts. So one way to put this in finance terms is that the going concern value is better than the liquidation value. It's hard because COVID shocks, long-term trends coincide or go in different directions. And, restaurants, for example, super hard hit, but maybe long-term trends are pretty good. Other industries, the COVID epidemic accelerated permanent shifts away from their business models. Public support has also made it harder to tell you can't look at the balance sheet necessarily. Second issue, we really care about some firms much more than others. And is it better to continue or to liquidate is almost the wrong. It's the right question, but it doesn't highlight the vast differences in that you have many industries, say restaurants, where maybe the thing is profitable, but it would be easy to recreate something equivalent in the same location and with sort of the same people or equivalent people. But we're really concerned about some firms whose destruction is really value destroying, and they may be insolvent. Okay. They have intangible capital, and they may be, looking to a great future, although they're financially weak right now. And finally, the process, I think we talked about this already, it'll come back up, I'm sure. What's the expertise in the courts with these things? What's the administrative capacity? And there's reform efforts going on in the European Union to have better insolvency law, but this isn't done. And can we implement it at capacity? The banks make a lot of these decisions. They again have, potential bandwidth problems, and do they have the capital to take the rational decision? And finally, non-bank financing can be super helpful. And I think this is something the ECB, for example, is, been talking about. Okay, those are my slides. Thank you.
That's great, Bo, and right on the dot as well. So thank you for keeping to the time limits. Some really great points, and I think particularly the issue of viability we'll be coming back to in the discussion, but I'll hand it over to James Watson for his 5 minutes.
Yeah, thanks a lot. Thanks a lot. Morning, everybody. Thanks for the invitation to speak. Look, I think I agree with a lot of points that have been made. I think it's quite a familiar story now, I think. So as Alexandr said, firms have had to take on a lot of debt through this crisis, basically to give them the chance to survive. It's not been for investment, and many companies, I have to say, will be very uncomfortable about taking on those sorts of that sort of debt. It's been both through public support and as the last speakers emphasised as well, capital markets have come in, and particularly the bond markets. We've seen record funding through bond markets as well. And as I think, as everybody understands now, I think what's crucial is that going forward, we don't see a cliff edge. We don't see a sudden withdrawal of those support schemes. It's been very noticeable that people have said we haven't seen insolvencies through the last year in the way we would expect to see that, and that's been a result of that public support. So I think we've got, what have we got? 250 odd billion of public guaranteed debt going to corporates. We've got 350 billion of debt to corporates, to companies that's under public guarantee. So I think there's clearly a risk of insolvencies increasing as we gradually withdraw that support, as hopefully we come out of the crisis. I'm a little bit more pessimistic, I have to say, than the last speaker. I mean, he's quite right. If you look at those corporate bond yields for the high risk, even for the high risk companies, I guess they're pretty low. What I'd also say is, many SMEs, obviously, they're not using the bond markets, and it's many of those companies that we're particularly worried about. I mean, I think it's a good question that the previous speaker raised as well. Do we care about a restaurant? If the restaurant goes bust, let's say the restaurant exists, people can pick it up and start it off again. I do think there's huge issues if we do let a firm like firms like that go bust for two reasons. Obviously, there's organizational capital, as was hinted at, within the company that enables it to operate. The staff know how to work with each other, etc. But I think there's a longer term issue as well. In terms of trying to create an entrepreneurial society here in Europe. And if you do have a situation, I think, where companies such as that have been allowed to go bust through no fault of their own, I think that is potentially damaging for the entrepreneurial climate long term. So just a reflection on that. What do we need to do? As I say, a lot of good slides we've already seen. I was going to quote the World Bank data as well. So it's an important point, I think. In terms of the efficiency of solvency regimes, there's great differences. There's an AFME report with Frontier Economics from 2016. I think they say that you could reduce funding cost, bond cost, 18 to 37 basis points or something like that if you improve the efficiency of insolvency regimes, and that would obviously increase investment. So that's a long-term challenge, and I think improving capital markets as well are longer-term challenges as well. But there's more we can probably do in the short term as well. Alexandr quite rightly mentioned the National Recovery and Resilience programs. I think it's important potentially that those programs are used to provide insolvency support. It was disappointing that element didn't make it through the kind of discussions that we had in July into the final MFF, Next Generation Agreement, but they could come through the national programs. I think potentially as well, in the short term, member states should be making sure that their solvency systems, the institutions around that, the courts and such like, are able to operate effectively and efficiently, in the coming year or so that we can at least operate that efficiently. But there's obviously longer term reforms that also need to be made. So potentially those national reform programs, the Commission could be looking to improve insolvency regimes as one of the recommendations within them. And obviously longer term, we need to build capital markets. And the one thing, the final point I would mention at this stage as well, there is a risk that we're going to see higher insolvencies, also risk higher non-performing loans in the coming months, and that bank lending that we want to continue to go to companies, risk that could come under pressure. So we do need to think carefully about how, for example, we interpret the final Basel recommendations within the EU for banks, to make sure that we do that in a way that's still going to maintain lending to companies. But I'll leave it there for now. Thanks a lot.
Thanks, James. And I have to say, I particularly liked your point on the long-term psychological costs of COVID and its impact on entrepreneurship. I think that's actually critical and underappreciated in public discussions. I'll now hand over to Andra to talk us through some of the work the EIB's been doing on this front.
Thank you very much, Frederico. Thank you to everyone, and also thank you for the invitation and for thinking of us in such an important topic. I would like to first cover some logistics in case my connection, which doesn't seem to be perfect, doesn't work that well. I'm gonna disable video receiving. So Natalie, I'm gonna go in blind and assume that you're going to the slides that I'm covering. So that being said, I just wanted to briefly go through the status quo, or at least how the crisis was visible. Thank you. So far on our side, back at the EIB group. Indeed, it was let's say obvious that at the beginning of the crisis, I mean, this whole started with the shortage in the liquidity and cash position, and this was a natural effect of the fact that everything was in quarantine. And then we made this brief comparison with the great financial crisis back in 2008 and 2009, and then you can see on the right hand side that both profits and investments have dropped. So the drop in percentage, but also to a large extent also in amount, in billions of euros within the euro area, have been very much like what we have experienced during the financial crisis. But what happens nowadays, and particularly after the COVID crisis, and we don't longer see it here because we're just on the left side, we're just depicting what the situation was up until the end of last year, but obviously the crisis is continuing, and there seems to be a greater impact indeed on the investment needs and the finance gap for companies, because they're already indebted. So these companies have increased their liquidity needs, and luckily the national schemes and also to some extent the Pan-European Guarantee Fund has been able to meet these funding needs so far. But the challenge continues, and I particularly noted what James has mentioned about kind of steering the discussion towards the need, and not only James, steering the discussion towards the need of solvency support. So that if we go to the next slide, we can see how the loan growth evolved during the more steady year of 2019, and then we suddenly see the significant increase following the crisis. So there has been a very large demand in lending, and also in terms of guarantees. And we can see particularly not the dotted but the straight line. The peak there is actually representing the small loans, so the loans that go to support small companies that has been let's say outstanding, if I can use this word in a bad way. But another point which is also relevant today is this the national schemes and the asymmetric support. I mean, we also see this through the deployment of the Pan-European Guarantee Fund. I think not all, this only represents the euro area, so the 19 countries, but this is what we managed to come up with, let's say shortly, but it is to a large extent representative to the EU overall, and indeed, also the point of uneven support. I mean, some governments have been more have been faster in reacting to this crisis and providing credit support through lending and guarantees. But this, let's say, doesn't allow us to draw a conclusion, a homogeneous conclusion, as to assess what is the remaining extent of lending support across the EU. But we can obviously see that countries like Spain and Italy, and by comparison to Germany on the right-hand side, have been more prompt and in the volume, and also have provided larger volumes of guarantee and lending support. But this is just to say that, first of all, I think what we've all learned in the last year is that it's very hard to predict the situation going forward. We're certainly going through challenging times and volatile, and there has been an evolution from liquidity needs, with a particular focus on smaller companies which don't have so much financial buffer on their own reserves, and then we're slowly going towards up to the end spectrum, which is financing, pre-insolvency support, but also in between there is a lot of investment need support. I mean, for those companies that are now picking up their businesses and are trying to continue their investments or keep their investments at the reasonable pace, they need this support. So it's quite wide. The spectrum of needs is wide, and at the same time, the geographical distribution of support required is very volatile, depending on the national sources and the ability of the national programs to penetrate the market and actually meet the demand. And then that brings us to the Pan-European Guarantee Fund. This was part of, on the next slide, thank you. This was part of the Eurogroup agreed support measures, and I'm gonna go straight to it. It is the Pan-European Guarantee Fund, which is deployed together by EIB and EIF, so the EIB group, is meant to deploy, to generate up to 200 billion euros of investment through a guarantee, which is jointly provided by the EU member states that have decided to participate in this program. And then the amount that we raised through guarantee support, so the committed amount, because we're now talking about paid amount, is to date 24.4 billion, representing the contribution of 20, if I'm not mistaken, 22 member states. And the share of contribution of the member states is mirroring the each member state's share in the EIB. So we're kind of replicating the EIB structure in this fund, which has a main, so the primary purpose of this fund is to provide liquidity and short-term investment needs, at least at the time of setting this up. This was the objective. So the target is at least 65% of the investment mobilized needs to reach small enterprises, what we call SME, so very small not very small, but up to 200, roughly up to 250 employees. And it is quite diverse in terms of scope. It also covers, or it is meant to address mid-cap, so up to 3,000 employees entities, and then large corporates, which means above 3,000 employees. And at the same time, it is meant to provide support to public sector and other types of entities, such as public-private partnerships that are active in the area of health and health research. So this is what we're doing right now. I think it would be good to go to the end slide and conclude. It's just to say that it's picking up very well. There is a lot of demand on the market, and we see this need on the receiver side and our intermediaries that we need to be flexible and we need to be able to cover a broad range of support, from guarantees, funding, and most important nowadays, equity type of support, subordinated lending, venture debt, and so on. And we think that this is to say that a potential extension of the EGF beyond the end of this year might be beneficial given the unfolding of the crisis and the demand and the need, the type of need in the market. And thank you very much, Frederico. I think that would be all.
Thanks so much, Andra. That was great. And it's great to see the kind of level of public support that European institutions have been giving to European visitors all over the continent. We'll now move to the panel discussion. Just before we do, I'd really encourage participants to send through any questions they have. But I'll kick off with one for Alexandr on this question of administrative capability, because this comes up again and again whenever we discuss the questions of insolvency. And we know that it's a long-standing issue with many European countries that their insolvency and restructuring regimes aren't as efficient as we'd like them to be. But this is kind of a long-term reform project. What do we see member states doing in the short term to prepare for the wave of insolvencies that we're expecting, to make sure that they're properly staffed up, that the necessary restructuring experts and so forth are ready? Because even for those which have more efficient systems, we're sort of undoubtedly going to see a series of insolvencies and restructurings which will be of a magnitude that they're not really used to dealing with. So the member states really taking this time now, this kind of calm before the storm, to make sure that bureaucracies are prepared on the ground for it.
Obviously, this is a very important issue and a good question. I mean, clearly the Commission has been very closely following the developments in member states. I mean, there have been EU-level initiatives like the 2019 directive on insolvencies and restructurings, which was actually obliging member states to put in place effective pre-insolvency frameworks, which I think is one very important element of this. Although the pressure on insolvency schemes and processes in domestic economies will increase. That's clear. And one of the main channels how to deal with this would be to deal with the debt as quickly and as efficiently as possible. So not to go as far and let all for companies which get into troubles end up in the lengthy and often inefficient closing down. So in that sense, this is a very important element. On the good side, some member states have improved implemented improvements to their national legislative frameworks. On the other hand, also as many countries were hit very badly by COVID, and public administrations were to some extent impaired, the implementation of this directive has slowed down. And then most member states they've applied for extension of the deadline because of these reasons. So obviously this doesn't bode that well with the needs coming from COVID, but we do hope that things will get better. Clearly, part of the issue is as you mentioned, availability of qualified staff, practitioners, also capacity of courts there. And I've mentioned this before. The resources which are available from the recovery and resilience facility can be used also for these, and I would say should be used also for these purposes. So hopefully this will also allow member states to be in a better position. But overall the challenges is still there. We are trying to monitor the situation to gather the data, be able to compare benchmark national systems in order to also pass on the right messages and then allow member states to see where are the main weaknesses, and then so that they can be afterwards addressed.
Thanks, Alexander. That's great to hear. By the way, should any of the other panelists kind of wish to jump in on any of the questions, I'm kind of addressing them to individuals, but do feel free to raise your hand on chat or anything, or just jump in if you would also like to make a comment. I'd like to pick up on this issue of viability, because again, it often comes up whenever we discuss the response, now that we're moving to more targeted measures, that we need to protect viable companies and let the non-viable ones go. But as Bo laid out very well in his opening remarks, it's quite technically and theoretically tricky to do this. Plus we have the practical issues, the bureaucratic issues of trying to implement this. So just a question for Bo, and then I'd actually be interested in James's view from the private sector. What's the kind of second best option? Optimally, we'd like to do some kind of fine-grained distinction between viability and non-viability, but should public services really be more generous than they otherwise would be, given the scale of the crisis and the sort of relatively blunt tools they have available at the macro level? One for you, Bo.
Yeah, gathering my thoughts. That's a big question. There's so many different policies across European countries, and they're quite different in structure, and the concerns you might have are different. And I'm not a great expert. Let me say this. Like, fundamentally, what are you concerned about in terms of over support and under support? I think if you don't support enough, you're worried that companies that will be hard to recreate are going to evaporate, with very serious negative consequences for employment and growth. What about overprotecting? Well, if you're too generous to firms, number one, it's going to be expensive. Right now, interest rates are at some kind of all-time or at least century horizon low. Borrowing is cheap, but I don't think you want to count on that. And so we should be careful about public spending. So that's number one. Number two, if we're supporting firms that aren't viable, and like we said, they're hard to tell apart, now we're just giving handouts to inefficient businesses. And we're locking in employment and capital in the wrong industries or activities. That's also bad for growth.
Indeed, there's a big trade-off, isn't there, between the kind of the immediate macroeconomic impact and the kind of longer-term structural views.
One way that this can be complicated is that we see, for example, during the COVID period, a lot of business has been done online. Okay, so offline retailers have suffered. How much of that is temporary and how much is just an acceleration of an ongoing trend which may persist? We don't really know. But to be really concrete, are people going to go back into the stores, or are they going to keep shopping online? We don't really know. So it's not at all easy. So unfortunately, I don't think there's an easy answer. I think the policymakers have done really well in this area. I think they're not given enough credit for how much better the public kind of fiscal response and public support stuff has worked, much better than the problematic public health policies in many places. It really worked very well, I think. You have to take it step by step. And so I think we're closer to not enough insolvencies. That's complicated by the fact that somebody, I think, mentioned in the Q&A that several countries in the European Union have moratoria on debt enforcement and insolvencies. And so what it means in those countries, the volumes are low, we don't know. But in the countries that haven't, that have just sort of given money to companies, the fact that there are low numbers of insolvency might be a sign that maybe we should more be worried about over support right now than under support. That would just be my hunch.
Thanks, Bo. And I suppose there's also the issue that I think one of you mentioned earlier in your introductory remarks, is that the key is to really avoid a cliff edge once these solvency rules and so forth begin to be turned on again, and we become more aware of the scale of the damage and the response that will be necessary. James, I saw you nodding along vigorously.
No. I mean, it's the right question, really. It's the big question. I mean, I'd agree with Bo. We've had a good, in terms of the economic policies, at least, the more financial side, I think it's been the right responses. But I think the difficult questions in a sense start now as we start tapering, as we start coming away. And I think, if you like, the zombie business question and how we distinguish what's a zombie business, what's sustainable in this new environment is the biggest question of them all. And I agree with Bo in a sense that, what we're seeing is we've seen accelerated structural change, if you like. And it also almost seems to me that the commissioners call these programs the National Recovery and Resilience programs. And I think it might as well have called them the National Recovery and Restructuring programs, because that's what essentially they're doing, shifting towards digital and shifting towards green in particular as the economy restructures. So I think it is difficult to work out in this changing environment exactly which are going to have long-term business models and which aren't. I don't have the answers. My only suggestion, I think, would be, where possible, try and work with the market using market-based solutions. So maybe some kind of subsidy alongside the market, bank guarantees and such like, or reducing lending costs, so that you're working with the market and you've got some kind of market discipline in there as a way of separating out the long-term, the viable and the less viable.
Thanks, James. And actually, this kind of builds on a point that Alexandr made at the end of your presentation about macroeconomic response and the role of the resilience and recovery, or recovery and resilience, I always forget which way around it is, plans. Is there an extent to which actually we can kind of short circuit some of the trickier questions around viability and so forth, and the extent to which targeted support should be extended to whom, by just having a strong macroeconomic recovery and response, and that can take care of the potential economic damage, but really let the chips fall where they may when it comes to what's viable and what isn't on the back of strong economic recovery.
Is that to me or Alexandr?
So that was Alexandr, but
that was for me. Okay.
if you'd like to respond as well, James, more than happy to.
Look, I cannot agree more. I mean, that was also the point which I was trying to do at the end. I mean, the future of most of these companies will be driven by the strength of the recovery. So if we manage to get ideally quick and then strong recovery, I think the situation of many of these firms will get resolved. So in that sense, also the huge investment impact of coming from the recovery and resilience or restructuring, if you will, facility will certainly play a role. In particular, since this money is also meant to be geared towards supporting these changes in the overall economic structure towards more digital and then also green dimension. So in that sense, they can also help the firms to prepare to the new normal, which will come after COVID, and then which we have already seen some of these effects, like going online and changing the production structure, the operations of firms. So all these things are somehow ongoing in some sectors more than in others, but clearly public administrations are incapable of judging whether these changes are in line with ensuring the viability of business models or not. So my second point here would be, despite if we were lucky and get very strong recovery, still some firms will get into trouble, and such decisions will have to be made. Their public administrations, obviously they should increase their capacity along different dimensions. On the other hand, they will never be in a position to make such judgment calls, and then that's why I very much also support the view that public sector should get involved, and then this basically cooperation between private and public sector could actually lead to identifying the viable businesses which are in need of help. Obviously, you will make mistakes. I mean, that's clear. But by leveraging the views and expertise from the private sector, also putting in incentives so that only firms which are kind of viable and are likely to use the money for good purposes, that they opt in. So that means some sort of co-participation. So all these elements can somehow help us, but there's clearly no very easy solution to this.
I saw in the news recently that France was looking to convert some of the kind of public guarantees that it had made over the course of the crisis into more equity-like instruments. So still preserving some of the incentives for market-conforming incentives, but reducing the burden on balance sheets. Do you think that this is maybe a kind of a middle way that the public response can go, reducing the debt burden, but still maintaining market-conforming mechanisms and giving the public sector a way to recoup its losses? I mean, that's sort of for Alexandr, but I feel like I've picked on Alexandr a bit too much today, so maybe I'll direct that one to Bo for his academic expertise, and actually to Andra, given that this is sort of down your down the EIB's street.
Okay, let me just. I mean, that's hard. This is unknown territory. Academics are better at stuff that has been around for a long time, that's been studied. Let me just make an observation about the difficulties of public equity. Okay, it's a well-known fact that publicly owned enterprises tend to be worse performers than privately held enterprise. Now, it's not super easy to make this comparison because, more nuclear plants than food stores are owned publicly. So it's not some kind of random thing that just happens. But there's been a lot of studies of the extensive privatizations in the 80s and the 90s, and they tend to point to the general conclusion that public ownership is bad. One reason public ownership is bad is that there's nobody who really cares. There's just no strong incentives to make sure the companies run well. And so it's possible that you can get away with a minority position. For example, the Swedish government still owns a big chunk, I think, of Telia, the largest Swedish telecommunication mobile phone company, although it was privatized like 20 years ago. So maybe you can just sit on a tiny slice and hope that the other owners take care of things. But I think if this is a lot of money, I think it's difficult to imagine that it's going to be, competent ownership. That's a drawback.
And on this not so positive tone, but I appreciate your point. And I was thinking now, for example, what the EIB and the EIF have been trying to do on equity type of support, which is not literally getting into to the best of my knowledge, getting into the equity per se of these companies, but going into deep subordinated type of transactions and fund-of-fund interventions. And if you do that in a way that is transparent and you have the appropriate mechanism, there could be some way to preserve accountability. And I think this is the role of IFIs in general to, it's not only about money, it's also about knowledge and the way you maybe demonstrate or provide the first example of this kind of investments, and then NPBs and national promotional banks can pick it up going forward. But going back on what Frederico was mentioning earlier, I think this leads us to the point that the recovery instruments, whatever those are, they need to be flexible and they need to be able to be redesigned in a fast way to address the economy. I can say from our experience so far in setting up the Pan-European Guarantee Fund, you don't have time to reinvent the wheel. You have to find a way to leverage on what you already know on the market and on the products that you already have, tweak them as little as possible, make them as open as possible, and try to put them on the market as soon as possible. I mean, there is literally no time to reinvent, and you have to stay flexible. I think that the example of the French government, and I think it's a very, very good one. And the other point that I would like to make, and especially because, okay, other than the equity part, we do a lot of intermediated support, funded and unfunded. Not only us, I think many other IFIs as well. And also the RRF, the Recovery and Resilience Facility, will have a lot of intermediated support. Intermediaries, be it national promotional banks, intermediary banks, non-banking, whatever, they are essential. They have the knowledge to the market, They have the first contact to the final beneficiaries, and they can tell us what actually is needed and what works. They are absolutely essential in this process. And I think we're really counting on them to get the money across, basically. And in a system where at least you can count on that, and then having a good, flexible national support, things can work. Not so fast as we would want them, not so efficient. It's very hard to find a one-fits-all solution. It's absolutely impossible. That's why you have to stay flexible, but you can make a bit of a difference.
I think those are some excellent points. And I mean, particularly the fact that we are, to a large extent, a bit path dependent on what our policy options are. We've got 5 minutes left, and so I'd like to shift the focus a little bit, but still sticking to the general issue of the debt overhang, because we've discussed a lot insolvencies and the insolvency wave and how we address it. But there will be a large number of firms which aren't insolvent, but have taken on a lot of debt. There will be won't want to take any extra debt on for investment. Their balance sheets will still be overloaded even if they're not anywhere near insolvency, and that will have a drag on investment going forward, particularly at a time when we're really relying on a spurt of private investment for the digital transition and green transition. So what can public policy do in this area to try and address this debt overhang, not from the insolvency perspective, but from the impact it will have on private investment going forward? I'll hand over that one to Andra, given that this is really kind of the EIB's bread and butter.
I was hoping I will bypass this, but I can tell you, Frederico, that, for example, we've started this program with the mindset of very short liquidity and investment needs. So initially we were thinking, I'm gonna talk from this experience, and then maybe we draw the conclusions together. So we were thinking at very short term, and this is also what I think the European Commission was thinking by the way they drafted the framework, let's say, allowing national schemes and EGF to work. But then the deeper we went, we realized that some of the support is actually needed to be directed towards longer term investments, going up to, I don't know, 6 to 8 year investment plans. And what we can do, and also I think I would assume the national schemes are also, I don't have a lot of visibility here, I know some of them have done, was to make this available. But that doesn't mean it will be picked up, or it doesn't mean that all industries will be homogeneously interested or needing that, because they don't have the visibility about how the economy will evolve. So I think what we can do is fill our shelf with as many options as possible, and stretch even the tenor of investment loans, and maybe be a bit more flexible. And by we, I mean also national schemes, on the eligibility, right, to allow them to survive in a way. And then we leave it up to them, together with the banks, to kind of pick up whatever they need from that. It's not like the vaccine. You cannot cure it. Like, yeah.
No, it's a real challenge. Just before we wrap up, I'd be really interested in James's kind of private sector perspective on this question, on private investment going forward. I mean, how do you think it looks? Do you think it will be severely impacted by this debt overhang?
Well, I mean, at the moment we're seeing very, very low levels of private investment, and essentially that's due to a lack of confidence going forward. So there really is about confidence. It's about having that long-term policy framework in place as well. So particularly if we're thinking about, the whole environmental side, the energy side, infrastructure, you do need that long-term framework. You need that certainty. These sort of investments are on huge, huge long-term schemes. So getting that policy framework that provides certainty is very important. But there's much more we could need to do. It's not just about access to finance to build that investment climate. We picked on one issue today around insolvency frameworks. We could have talked broad about administrative burdens. We could have talked about labour market regulations and such like. So we're only going to get that long-term investment if we create the broader investment climate that we need.
Right, thanks, James. And I mean, hopefully with the recovery and resilience plans coming into gear, that we'll start to see some of that broad-based policy support and framework for building back better, as people like to say. Okay, we're coming to the end of our time now. I think this has been a really invigorating and insightful discussion, and I hope the participants have enjoyed it. And I just want to thank all our panelists for their insight and for taking the time for sharing their insights with us and with the viewers. Right. Thank you very much, everyone.
Thank you.
Thank you.